Hi everybody, this is Alan Ellman, the Blue Collar Investor. In Lesson 2 of the Beginner's Corner Information Series, we're going to discuss option basics as it relates to our covered call writing strategy. In order to use this strategy, we have to be able to talk the talk. So there are certain definitions that we must know and understand thoroughly before we start investing with covered call writing. The good news is there aren't a lot of definitions. Let's first redefine the covered call writing strategy as we discussed in Lesson 1. When we do covered call writing, we first buy a stock and then sell the option. We're selling to the option holder the right, but not the obligation, to buy our shares from us at a certain price called the strike price by a certain date called the expiration date, always the third Friday of the month. In return, we receive a cash premium for undertaking this obligation. This is called the option premium, and it's generated into our brokerage accounts instantaneously. Now there are two types of options, so let's define them. The call option is the right to buy 100 shares of stock. If you recall, one options contract consists of 100 shares. The put option, the opposite, is the right to sell 100 shares of stock. In covered call writing, we deal only with call options. We are selling the right, but not the obligation, for the option holder to buy our shares at the strike price by the expiration date. And once again, in return, we receive a cash premium. Now let's take a look at the strike price, or the price that we agree to sell our shares for, as it relates to the price of the stock. There are three definitions. The first, the at-the-money strike price. That's where the price that we agree to sell our shares for is the same as the current market value of the stock. So for example, we buy a stock for $30 and then agree to sell it for $30. Now, closely related to the at-the-money strike price is the near-the-money strike price. So let's say, for example, that we bought a stock for $30.15 and sold the $30 call option. Well, that's not precisely an at-the-money strike price, but it's a near-the-money strike price. They're very closely related and almost the same. The second definition is the out-of-the-money strike price, and that's the one we explored in our preview example, where we bought a stock for $28 and sold the $30 call option. Since the strike price is higher than the current market value of the stock, it's said to be out of the money. Finally, we have the in-the-money strike price, and that's where the strike price is lower than the current market value of the stock. An example would be as if we bought a stock for $32 and then agreed to sell it for $30. That strike price is said to be in the money. So we have two more definitions here, and it's relating to the option premium itself, as that relates to the strike price. Now, before we get into it, there's an equation that everyone has to learn and understand before you get involved in covered call writing. And that equation is at the top of your screen now. The option premium, or the cash that we're going to generate from the sale of our option, equals intrinsic value plus time value. So let's define those last two terms. Intrinsic value is the dollar amount that the option premium is in the money. So for example, if we bought a stock for $32 and sold the $30 call for a premium of $3, the intrinsic value portion of that $3 premium is $2, the amount that the strike price is in the money. The amount that that $30 call is less than the current $32 market value of the stock. Now, the time value of that option premium is everything above the intrinsic value. So we receive $3 from the sale of that option, $2 of which we now know is intrinsic value, that leaves $1 for time value. So once again, if we go back to the equation at the top of the screen, in this case, the option premium of $3 equals intrinsic value of $2 plus time value of $1. Our profit is only the time value. Now, only in-the-money strikes have intrinsic value. So if we sold an at-the-money strike, buy a stock for 30 and sell the 30 call option, or an out-of-the-money strike price, buy a stock for 28 and sell the $30 call option, okay, those premiums consist only of time value, only of profit. Okay, folks, that takes care of the definitions. Now, if you recall back to our preview example, we said that we bought the stock for 28 and sold the $30 call for $1. Well, how do we know that that's the price we're going to receive from the sale of that option? Well, the answer is we must go to an options chain, which is a list that quotes options prices for a particular security. All of the online brokerages have these, and there are many free websites as well where we can get this information. Today we're going to look at a free site, finance.yahoo. So when you go to that site, this will be the home page that you see on the screen now. And in the upper left-hand portion where the red arrow is, where you type in the ticker symbol of the stock whose options chain you'd like to look at. Then where the blue arrow is, you click on Get Quotes. That will take you to the next page, which you see on the screen now. And where the red arrow is on the left, there's a link for options, and you simply click on that link. And that will take you to the options chain for the stock that you were looking for. In this case, we typed in NUAN for nuance. And there are several things within this options chain that we should all become familiar with. So let's start on the upper right-hand portion of your screen, where you see circled in red the current market value of the stock, which is $24.07. Now, the options chain itself has a lot of different rows and columns. So let's first take a look where we have number 1 on the left-hand portion with the red arrow, and that shows the strike prices available for this particular stock. Once again, the strike price is the price that we'll agree to sell our shares. Now, since the current market value is $24.07, we're going to take a look at the $25 out-of-the-money strike price. And I've highlighted that row in green on the screen. So the 25 in the column all the way to the left represents the strike price. And under number 2, where the red arrow is the ticker symbol for that particular option. The ticker symbol consists of the underlying stock, in this case NUAN, the expiration date. The C in the middle tells you that it's a call option, not a put option. And then after that you'll see the strike price listed. In this case it's 25,000. There's no decimal point ever put in, so it's 25.000. Now, if you look to the middle of the screen, the red arrow in the middle under the bid column. When we sell an option, we always sell at the bid, which is the lower of the bid ask, and we would buy it at the ask. So we look to the bid column, and we go down to where the row is again highlighted in green, and circled in blue you will see that we would generate a commission of 75 cents per share, or $75 per contract. Now, we're not including commissions because we're going to be using online discount brokers, a topic we'll get to later on in this series. And those commissions are so low they're basically a non-event, or they affect our bottom line results to a very small extent. Now, another thing that we may discuss later on is how to negotiate a better price than the 75 cents. That's a subject we'll get to when we talk about the bid-ask spread. And finally, if you look all the way over to the right-hand column in the rectangle labeled number 3, you'll see open interest, and that basically will tell you the interest that other investors have in this particular options contract. And if you take a look again to the row highlighted in green all the way to the far right, you'll see that there's 12,607 contracts still open. In my system, I look and require a minimum of 100 open interest contracts and or a bid-ask spread of 30 cents or less. And that will tell you something about the liquidity, or how easy it'll be for you to buy back that option should it become necessary when we do our exit strategies, a subject that we're going to discuss in greater detail later on in this series. So that basically gives you the important information that you'll find on a typical options chain. Now, when you do your calculations, what you do is you take the amount of cash generated from the sale of that options contract, 75 cents per share, $75 per contract, and what you do is you divide that by the amount that you've spent on the stock. When the stock was $24.07, if you bought 100 shares, that's $2,407. $75 represents a 3.1% 1-month return. So let's summarize now options basics as it relates to the strategy of covered call writing. Options are contracts that give the holder the right, but not the obligation, to buy or sell stock. We deal with call options, the right to buy stock. We are selling to the option holder the right, but not the obligation, to buy our shares from us. Strike prices can be at the money, you buy a stock for $30 and sell the $30 call option. In the money, where you buy a stock for $32 and sell the $30 call option. Or out of the money, where you buy a stock for $28 and sell the $30 call option. Option premiums, or the cash that we generate from the sale of these options, consist of intrinsic value, which is the amount that the strike price is in the money or lower than the current market value of the stock, plus time value, our profit. An options chain quotes options prices and gives you other information. In Lesson 3, we're going to discuss stock selection by using both fundamental and technical analysis. Take care, everybody.